guys, I'm here to share with you about the my stock account update. Today's market generally closed lower. United Natural Gas closed out with a gain of 1.00% to $7.07 per share, and SQQ closed up 3.38% to 20.78. The market generally closed lower. All three major indexes closed below the opening price. Dow Jones Industrial Average closed down 0.84%. Nasdaq Composite closed down 1.17%, and S&P 500 closed down 0.77%. The healthcare industry and the auto manufacturers all closed with a loss of about 7%. The double killing of the stocks and the bonds prices recently have continued, and the 5% world of interest rates is opening up. After strong labor data on Thursday rekindled investment fear interest rate hikes, U.S. Treasury yields continued to climb on Thursday, and the three U.S. major indexes fell again across the board, and the stock and bond double kill scenario in the U.S. market in the past few trading days does not seem to have changed. The yield on the 10-year Treasury note rose to 4.307% from 4.258% on Wednesday, the sixth straight session higher, rising further to its highest closing level since 2007. And the yield on the 30-year Treasury note had a 12-year high of 4.411%. The U.S. equities continue to weaken, extending losses that have been partly caused by a sharp surge in yields since August. The S&P 500 and Dow Jones fell 0.8% throughout the day, while the Nasdaq Composite fell 1.2%. The tech-heavy Nasdaq Composite is particularly sensitive to rising interest rates, having fallen 7.2% so far this month. Surprising resilience of the U.S. economy, ballooning debt and deficits, and escalating fears that the Federal Reserve will keep interest rates high for a longer time are converging long-term Treasury yields to their highest level in more than a decade. This has also forced people to start rethinking what will the future normal of the U.S. bond market look like. In this regard, a new warning from BOA strategists may be particularly sobering. It reminded investors to prepare for the return of the 5% world before the 2008 global financial crisis, and the BlackRock and the Pacific Investment Management PIMCO also said U.S. inflation may remain stubbornly above the Fed's target, leaving room for further gains on the long-term yields, and the entire Treasury yield curve has all been above the 4% yield mark. The bond market is returning to its pre-financial crisis normalcy. Once upon a time, the rule of thumb for bond traders is that the yield on the 10-year Treasury should be around 4%, a 2% inflation target plus 2% real yield, which roughly reflects the economic growth. Now it's more or less recurring, with investors pricing bonds based on inflation expectations about 2.4% over the next 10 years. Plus a real yield of 1.89%, and the nominal yield of 10-year U.S. Treasuries is now around 4.2%. This real yield is also broadly in line with the average expectation of Fed policymakers, who expect long-term economic growth to be 1.8% per annum. The danger for the financial market is that for more than a decade after the 2008 and 2009 financial crisis, interest rates were near zero and often below inflation, and the U.S. global economies became dependent on cheap money. For all the risk of a bigger trouble is a concern, the U.S. economy has long relied on the cheap money, and the symptoms of withdrawal are just the beginning. That's all I have for today. Thank you for listening. Love you, so subscribe and see you next episode.